Welcome back to Cryptowhizz, your number one stop place for your knowledge on cryptocurrency and blockchain. Make sure to give this video a like and subscribe to the channel as we provide the latest and greatest in crypto. In this video, we'll go through several crypto tax information, such as 5 crypto tax-free countries, when exactly do crypto taxes take place, and what Americans pay in taxes versus Europeans. Now, let's get right to the video. In the US, cryptocurrencies like Bitcoin are treated as property for tax purposes. Just like other forms of property, such as stocks, bonds, and real estate, you incur capital gains and capital losses on your cryptocurrency investments when you sell, trade, or otherwise dispose of your crypto. Depending on what tax bracket you fall under, you will pay a certain percentage of tax on this capital gain. Tax rates fluctuate based on your personal tax bracket and whether the gain was short-term or long-term, more on this later. Outside of buying, selling, and trading, if you earn cryptocurrencies, whether through a job, mining, staking, airdrops, operating a node, or interest from lending activities, you are liable for income taxes on the US dollar value of your crypto earnings at the time you receive the cryptocurrency. So when does one start paying taxes? Whenever you incur a taxable event from your crypto investing activity, you incur a tax reporting requirement. A taxable event simply refers to a scenario in which you trigger or realize income or previously unrealized gains. As seen in the IRS virtual currency guidance, the 4 following events are all considered taxable events for cryptocurrency. Number 1. Swapping crypto into fiat like the US dollar. In this example, Emma incurs a $200 capital loss, $1,000 to $1,200. This loss gets deducted and actually reduces Emma's taxable income or can offset capital gains from other investments. Number 2. Trading one crypto to another. In this scenario, John incurs a taxable event by trading his Litecoin for Ethereum. Trading one crypto for another is treated as a disposal, and here John incurs a $150 capital gain, $400 to $250, from the trade which he would need to report on his taxes. Number 3. Spending crypto for goods and services. In this case, Taylor buys Bitcoin for $500. She then trades that Bitcoin for a $51,000 car. Taylor now incurs a $50,500 in capital gain. And number 4. Earning crypto as income. Common forms of crypto income include earning crypto staking rewards, crypto interest, crypto referral rewards, and airdrops. Taxes in the EU. Throughout the EU, although there are overall guidelines and regulations regarding cryptocurrencies, regulation and by extension taxation is still up to individual countries. Recent news from France shows that there is a push to set up a common framework for regulation not only at the EU level, but on an international one. The French Minister of the Economy Bruno Le Maire wants the issue to be discussed at the G20, and although a noble vision, global regulation is unlikely to be agreed upon anytime soon. A more attainable goal has been set out in the European Parliament recently, where ministers overwhelmingly voted for powers to address anonymity issues. This follows on from a report released in the middle of 2018 detailing the use of cryptocurrencies in organized crime, money laundering, terrorism and tax evasion. These practices involve funds worth more than €7 billion worldwide. Even though uniform taxation may eventually follow, at the moment, the main focus is on countries/companies being able to conduct due diligence and apply KYC/AML standards effectively. The issue of taxation for regular, law-abiding citizens won't be settled until there is a consensus of what cryptocurrencies actually are. There are still debates over some fundamental aspects, such as whether cryptocurrencies are currencies, assets, or securities. Then there are differing viewpoints regarding how a person uses these cryptocurrencies. So what are some crypto tax-free countries? Let's take a look at 5 countries and what they entail. Number 1. Germany. We'll start by saying that crypto isn't totally tax-free in Germany, but they do have some quirky crypto tax rules that mean investors can easily avoid crypto taxes. Germany views Bitcoin and other cryptocurrencies as private money, not a capital asset. This matters because if you hold your crypto for more than a year, when you later sell, swap or spend your crypto, you'll pay no tax on it. Holding your crypto is key, because crypto held for less than a year is taxed unless the profit is less than $600. Another quirk is the staking rule. If you've staked your crypto to earn further income, this crypto would be subject to taxes regardless of how long you've held it. It's only after 10 years of holding your crypto that staked crypto would be tax-free at the point of sale. So provided you HODL, your crypto is tax-free in Germany. But before you pack your bags for Berlin, it's not all good news when it comes to crypto tax. Germany does still subject some crypto to income tax, including getting paid in crypto, mining crypto, staking crypto, selling, swapping or spending crypto you've held for less than 1 year if the gain is more than €600, and selling staked crypto within 10 years. Number 2. Singapore. There's a reason many crypto exchanges, like KuCoin and Phemex, are based in Singapore. Singapore is a crypto tax haven for both individuals and businesses. This is because Singapore doesn't have a capital gains tax, so individual investors and businesses are not liable for capital gains tax. So when you dispose of crypto by selling it or trading it, you won't pay capital gains tax. As well as this, because cryptocurrencies are viewed as intangible property from a tax perspective, when you spend crypto on goods and services, this is viewed as a barter trade, not a payment. Of course, you can't avoid all taxes. If you're acting as a business and you accept crypto as payment, you will pay income tax on it. Similarly, if a company's core service is related to crypto trading, the company would still be liable for income tax. And number 3. The Cayman Islands. It should come as no surprise the Cayman Islands are on this list. The Cayman Islands have long been known to be a tax haven for both businesses and investors outside of the crypto market, and crypto is no exception to their tax laws. For both crypto businesses and individual investors, the Cayman Islands is a crypto tax haven. The Cayman Islands Monetary Authority imposes no corporate tax on businesses and no income tax nor capital gains tax on residents. Instead, the Caribbean paradise earns revenue through tourism, work permits, and GST. Number 4. Malta. Also known as Blockchain Island. The country recognizes Bitcoin and other cryptocurrencies as a unit of account, medium of exchange or a store of value. What this means is you'll pay no capital gains tax on long-term gains from selling crypto, provided it is considered a store of value. So it's good news for holders. This said, crypto trades are viewed as similar to day trading stocks or shares. As such, they attract the business income tax rate of 35%. There are, however, structuring options within the Maltese tax system that allow you to reduce this tax rate to between 0% to 5%. It all depends on how much you earn and your residency. And number 5. El Salvador. El Salvador made headlines around the world as the first country in the world to make Bitcoin a legal tender. The country is hoping that in doing so, they'll attract more investment into their economy. To further promote this, the country also now exempts foreign investors from paying any tax on Bitcoin gains or income. In even better news, because Bitcoin is a legal tender in the country, businesses must accept payment in Bitcoin. So in El Salvador, you can pay for a huge range of goods and services in Bitcoin that you wouldn't be able to anywhere else in the world. If you liked this video, make sure to give this video a like and subscribe to Cryptowhizz, the #1 stop place for your knowledge on cryptocurrency and blockchain. Don't forget to comment down on this video any topic you'd like for us to cover. And remember not to take anything as financial advice.